So my main idea on gold for some number of weeks is that it was going to move up into mid-January and then dip down into mid-March. Well, it did shoot way up and made a slight new high above the early September high, gold did. And now some people are taking that as, okay, well, what we have here is 1, 2, 3, 4, 5 waves up from this low. Others are starting at this low here and going 1, 2, skipping over this, 3, 4, 5, and calling it. That's what I think Elliott Wave International is saying. Oh, tops in, that's it. Well, let's, and maybe some of you know, but what would be the best target? What is a characteristic? This is a question I'm opening to the chat. What would be a characteristic of a typical characteristic of a fifth wave in gold? Put in your answers. What would be a typical characteristic of a fifth wave in gold? And if you wanted to give a potential Fibonacci target, then that would be great too. Getting a lot of answers. Longer than the third, extended, trends like crazy, extended, vertical move up, longest wave. All those are correct. So in the stock market, the longest waves in an impulse of 1, 3, and 5 is typically wave 3, very common. But in a commodity, especially gold, silver, the longest wave of 1, 3, and 5 in an impulse is typically fifth wave. Do you think it would be smart to call a shortish fifth wave a fifth wave? Well, let's see if we can determine a way to decide that. So here's daily 5 waves up in gold or something else. I'm probably going to make a blog post about this, or maybe a little movie. So I've entitled this chart 5 waves up in gold or something else. So this is, I've got my main wave count and alternate on the chart. So here's the August of 2018 low. I've got that as a black or intermediate degree wave 2. And then up from there, blue wave 1, blue wave 2, blue wave 3. And I've been refusing to call this the end of a blue wave 4 because Hearst was calling for a top originally in mid January, but then as we started into this move to the upside, it was saying no, that top is probably going to occur in the first week of January. And so because of what Hearst was suggesting there, I was saying, no, this would be a very choppy corrective wave A. This is just going to be a B wave. And then we would get a C wave down to complete either a wave 4 or possibly another wave 2. So it'd be like 1, 2, 1, expanded flat for 2. So I've been looking for this to be basically a flat. So how can we tell the difference? Well, if you draw a Fibonacci from the wave 3 top down to my pink wave A top and look for a top for wave B that is most typical, it would be that wave B would be 1.382 times the length of wave A. And that is exactly to the tick where gold stopped going up. And then one would expect, so this would be essentially a 3-wave structure to downside, a 3-wave structure to the upside for wave B, and then a 5-wave structure to the downside to complete an expanded flat. And I even have a target down here for the end of wave C in gold. That'd be down here at 1418, and currently Hurst thinks that will move down into March. I'll draw it in March here. So this is March. So if gold is done moving up right now, it looks like it with that very large pin candle, very large reversal. It looks like it is done going up now. It would likely give a 1, 2, 3, 4, 5 waves down. Next, to complete an expanded flat. That expanded flat could be a wave 4 or possibly another wave 2. Some are just saying, no, what we got here is we've got 1, 2, 3, 4, 5. We have 5 waves up. So where would the typical fifth wave target be in a commodity? It would be an fairly extended target. I would say the minimal target for wave 5 in gold, a commodity where fifth waves are typically can be the longest of waves 1, 3, or 5, would be at least where it was wave 5 was equal to the net traveled of 1 through 3 times 0.618. So that's at 1734. 70, that would be the minimal expectation for wave 5 in a commodity. And there would be higher targets from there. Matter of fact, what if wave 5 would be in a commodity equal to the net travel of 1 through 3? Well, that would have put gold right up very close to its all-time high of 1941, and much higher than that. And much higher than that is still possible. I remember moving into the 2011 high. Silver, the fifth wave in silver was approximately 1.618 times the net travel of 1 through 3. So some of these targets, especially in gold and silver, highly emotional items, would be far, far extended, far larger than this wave that we've seen so far. So if we've seen the top in gold here for now, and we see a correction back to the downside, maybe into the low 1400s, this wasn't a fifth wave. It's just not, it doesn't meet the standard for what you'd expect in a fifth wave. So that's some presentation I wanted to make this week in the webinar, that if we do continue to the downside here without, if gold continues strongly to the upside now, then yeah, we can write this off as something other than a B wave, and it breaks out, makes new highs. But it would have to do that in order to really be a characteristic fifth wave up in a precious metal. And that is why when I look at my wave count, and been refusing to expect a breakout beyond this level that we've saw, which the high tick so far is around 1615. The reason I've been refusing to expect it to break out higher is the position of a 20-week cycle peak due in early January. And that is Hurst cycle analysis. And so now I'm looking for this move down into March, maybe even April in gold. The 120-minute chart in gold showing this week shows a really clear 5-wave structure to the downside in gold. So whatever gold does, and as it recovers over the next few days, I think will be a corrective structure, and will likely stop going up somewhere in the typical Fibonacci retracement zone. Somewhere between 1576 and 1585 would be most typical for a wave 2. That'd be a wave 2 in orange. Orange is sub-minuets a degree. And as you can see, Hearst doesn't think there's much more than maybe another day of upside in gold, and then it continues on lower. So there's gold. My algo in gold was long, moving into that spike to the upside, and suggested getting out of that trade as soon as it spiked and reversed in the same day. And it had a nice profitable trade. That's the momentum algo for premium plan subscribers. And another reason I didn't expect the breakout in gold to be anything more than a B wave was that the DSI only got down to about a 25 in gold there a few days into December, and that's as low as it got. And so I didn't think that was low enough for it to support an enormous fifth wave to the upside. Also, on that day, on the day of the spike, the DSI got all the way up to an 85. And if you look at my momentum algo, if the DSI, which is Daily Sentiment Index, is higher than 78 in gold, in other words, if more than 78% of retail traders are bullish, the algo, based on backtesting, will refuse to take any new long signals. And it indicates it's getting very stretched, and the upside may be somewhat limited from there.